Hi, this is James Shug with Westpac London's end of day market wrap for Tuesday, October the 4th. Really just two things to focus on today. The ongoing EU finance ministers meeting yesterday and today. Lots of asides, hints, leaks, some of them contradictory, have emerged from it. Nothing concrete, no formal statement or anything, but two things do seem to be clear. Firstly, the sixth tranche of the 2010 bailout of Greece, €8 billion worth, that was originally due to be paid in mid-September, then delayed till yesterday, then delayed till October 13, has now been pushed back to October 18 when we get a meeting of EU leaders. That, along with a lot of talk of an increased haircut for creditors of Greece, who take up the deal that was put together back in July, where they swapped their sort of toxic Greek debt for longer term Greek debt, and with a haircut of around 21% when they take up that deal. There's talk that haircut's going to be technically adjusted. Now, put the two together, the delayed Greek payment again, and talk of increased pain for creditors, it's got investors thinking, are the bailouts falling apart? Is something bigger going to be put in place that's going to involve even more participation, pain on the part of creditors? We don't know, but investors certainly didn't like the news out of Europe related to Greece today. The second big story was Bernanke. He delivered testimony to the Joint Economic Committee in Congress, and he went on and talked about the struggling economy, much of what he was already written in a more concise form in the September 21 FOMC statement, but there was one sentence that had some key wording changes. Basically, on September 21, the statement said that the FOMC will continue to assess the economic outlook in light of incoming information and is prepared to employ its tools as appropriate. Today, Bernanke said that the committee will continue to closely monitor economic developments and is prepared to take further action to promote a stronger economic recovery. Okay, so if you regard closely monitoring as implying more concern than merely assessing, and when you consider that he talked about further action to promote a stronger recovery, it's pretty clear that he's got more of an easing bias. You could regard that statement, I think, as the 2011's Jackson Hole moment, which I'm referring, of course, to the time in Jackson Hole in August 2010, when Bernanke hinted at QE2, which ultimately was delivered a few months later, starting in November. So for those of us that have been arguing that there will be a further round of quantitative easing, QE3, today was a pretty important date. Remember that, October the 4th. Okay, a bit of data out. Factory orders down a tiny bit in the US. UK construction sector pretty soft, or just basically stalled in the latest September reading there. So let's move on to markets. They're not pretty. In Europe, we've got losses of 2.6% on the London market. The French market's down 2.6% as well. The German DAX is down 3%. We had Deutsche Bank abandoned its profit forecast. It's going to lay off more workers. A few other banks have come under rating agency watch consideration because they haven't fully written down their exposures to Greece. The banks, of course, have been hit hard just generally by this concern about the increased creditor participation in the Greek bailout process. So significant losses there. The US opened weaker, then rallied back to about flat after the Bernanke comments. Further quantitative easing could mean, like it did with QE2, more money floating around to go into the equity market. But it didn't last long, and the Dow, as I speak, and it's 20 to 7 in the evening, the Dow, as I speak, is down 1.2% at 10,533. The broader S&P measure is only down 0.5% though, because the Nasdaq's up a bit. Tech stocks are doing relatively better, but nevertheless, the vibe on US markets is pretty negative, mainly because of the European situation. And Bernanke, even though he hinted at QE3, he couldn't. It seems well, at least at this stage, he hasn't been able to push markets back into positive territory in any sustainable way. Commodity markets, just running through them quickly. Oil's down 1.2%, copper's down 1.8%, gold's down 2.5%. Quite a few losses there. And the Aussie dollar's weaker too. It's at 94.5 US cents at the moment, but it actually dipped below 94. We had a 93 big figure just temporarily an hour or so ago, but as I say, back above 94 at the moment. And in Australia today, you've got retail sales figures coming up for the month of August. We're looking for a fall to be reported. If we're right, another bit of evidence supporting our view that the Reserve Bank will be cutting interest rates before the end of, or by the end of this year. Certainly we took some comfort from the RBA's statement yesterday, which for us at least hints that the bank already has a mild easing bias. Okay, so plenty more to talk about later this week. Jobs numbers coming up in the US. Oh, one thing I would say, when a central banker starts talking about concern about the employment market in the week of the main jobs report for the month, that's usually a sign that it's going to be a weak one. So I'm very comfortable with my forecast for payrolls, which is that it will only rise 30,000 in the month of September. More on that later this week. See you soon.